Good evening, friends. Hope you all are well and doing fine. I'm Ashok Kanawala on behalf of HDFC Mutual Fund. Welcome you all to this call to discuss economy and market outlook. So to say, we are at a very interesting juncture. If I look at just previous year, market around a year back was roughly around 66,000, had a low of around 63,000, and during the last 12 months made a high of around 86,000, and right now it's close to 82,000. So we have seen a range of 23,000 points, Sensex points in last 12 months. And if I go back to the COVID days in March 20, when the Sensex was roughly around 25,000, from there in last 4.5 years, it has more than tripled. So I think we are in for an exciting time. Things are working out very well for India in terms of its growth, in terms of its macro outlook. And despite the global uncertainty, so we had two classic wars going on right now also, Russia, Ukraine, and Middle East doesn't seem to be softening. In fact, it seems to be intensifying. Despite that, our markets have continued to rally. And of course, we have seen some kind of consolidation in recent time. So we have with us Mr. Rahul Baijal, Senior Equity Fund Manager, who has more than 2 decades of investment experience. And he will be taking us through his views on the global economy and, of course, the Indian economy and, of course, the valuation perspective, how markets are looking from a valuation perspective, and how different market segments, so large, mid, and small, are looking relative to each other. And of course, what are the opportunities at this juncture? So everybody must be thinking at this look close to all-time high, where do we find the opportunities? And Rahul has been managing amongst various funds. HDFC Top 100 is one of our flagship funds. Very recently, on October 11, it completed 28 years of its successful operation. So it has a legacy of last 28 years. Of course, at HDFC Mutual Fund, we have a couple of funds which have completed more than 25 years. And of course, Top 100 is one such strategy. And when you talk about 28 years and when it comes to investment, what we often find that investors focus on a very near-term performance, last 1 year, 2 year, 3 year, maybe 5 years, and forget the long-term track record or history of a fund. And that's where Top 100, which was earlier known as Top 200, stands out. And why I'm saying, because I must personally have more than 3 decades of experience of capital market. And when I talk about this fund, what it has not seen, starting with Asian crisis and tech bubble and terrorist attacks of 9/11, then global financial crisis of 2008, very recently COVID times, changes in government at the center at various times leading to heavy political volatility in the stock market. So despite all this thing, it has created wealth for its investors. And how is that? That if you would have invested 1 lakh at its inception, today that 1 lakh rupee is close to 1.5 crore. That is compounding at the rate of more than 19%. And even similarly, if I talk about SIP of 10,000 since inception, so that is roughly close to 33.60 lakhs, 33 lakh 60,000 invested till date, the value of that is today close to 9.5 crore. So that's the kind of track record this fund is boasting about, despite various challenges. And it has navigated all those challenges rather very well. And now we have Rahul, who's spearheading this strategy. And Rahul also has a track record of managing large cap strategies earlier also before joining HDFC Mutual Fund. So he's the best guy to look at such strategies. And for India as such, we don't think the story has sort of a change with kind of uncertainty going around in the global market. And if India continues to grow as the way it has been growing in last couple of years, then the story of Top 100 is far from over. So without getting much into detail, now we have a special expert, Rahul Baijal, who will be taking us through his thoughts on the economy and market. So, with this, I will now invite Rahul to begin his opening remarks. Over to you, Rahul.
Yeah. Thank you, Ashokji. Is the presentation visible?
Yes, Rahul.
Okay. Thank you so much. So, good evening, everyone, and welcome to this session of HDFC MF Perspectives. Uh, so today, what I'll do is I'll spend initial 10-15 minutes on the overall macro, how I'm looking at India macro and the global macro in the background, and then talk about why I think large caps are looking attractive in the current market environment, and why there's a case for outperformance to pick up over there, and then end the presentation with the strategy and the positioning of top 100 fund, which, as you know, is the flagship large cap product at our end. So, firstly, on the big picture, overall, a lot has been talked about, and you must have heard from other presenters as well. But I'll just focus on a few key slides. Firstly, I think the big picture is, clearly that India is looking very attractive on the growth front. If you look at how we are placed versus the other emerging markets and even the developed world, and is poised to be one of the fastest growing large economies in the world. And as we stand at $4 trillion right now, there is confidence and faith and visibility that we can be close to $6 trillion by the end of 5 years, and with headroom for more. And as you travel this journey, various estimates peg us that we'll cross Germany and Japan in terms of the size of the GDP in about 2-3 years' time, and go on to become the third largest economy in the world. Now, the big question is, can we do it? And do we have the wherewithals? And I think the answer is yes. This is one of my favorite slides, and this summarizes the journey of India across various parameters over the last 2 decades. And I came to Bombay in 99. In the last 25 years, last 20 years, I've spent, in the fund management side. And I've seen this journey unfold right in front of my eyes. And I think the important aspect of this journey has been that not only growth has come through, but the quality of growth has also come through. And I think if you look at the journey in two parts, the last 10 years and the previous 10, the quality of growth has been particularly better over the last 10 years, when most of the other macroeconomic parameters, which are important from a macro fundamental perspective, whether it's fiscal deficit, inflation management, current account deficit, forex reserves, and the rupee volatility, they have been fairly well managed over the last 10 years. And it's only around COVID that we saw around FY21 that growth suffered a bit, and fiscal deficit also suffered. But now we are back on track. Growth has come back to 7% plus minus. The fiscal deficit is well under control, and the budget this year gave clarity on the path ahead. And inflation management has also been very well, and we are looking for rate cuts ahead, depending on how the US macro and other parameters shape up. So clearly, quality of growth, which was some concern around the elections, I think after the elections, we've seen policy continuity. We've seen the budget come out, which is reinforced the policy continuity by the new team. And there's clear confidence that India's macro can continue within these ranges over the next 5 years. And that's what I'm most excited about. And I think that's what gives me the confidence that yes, India has the potential to cross 6 trillion at the end of 5 years. As far as the contributors to this growth, the government has been doing a great job in terms of the capex, but most importantly, uh, the private corporate capex and the households capex in the form of real estate have also started to contribute. And now we have data because you can see overall also the gross fixed capital formation in India has picked up over the last 2 years. And the government has been doing a good job on building the physical infrastructure. So as you all know, we have one of the best digital infrastructures in the world, and foreign tourists, have amazing experiences of using Paytm at all kinds of places. But physical infra is where we have been lacking, but I think the catch up is happening. And the good news is that private sector capex is finally picking up. And I think you can see the data also over here, which has come through last 2 years in the listed corporates. We are seeing clear evidence of 20% plus growth in the listed corporates. This is data from the RBI. The capacity utilization levels are running in late 70s, which is a typical threshold when the private sector capex actually accelerates. And the data coming out from the banks also is suggesting that the approvals are picking up pace. So I think there is a narrative, there is confusion out there. Is it picking up or not? I'm in the camp which believes that it's clearly picking up, and it should get better over the next few years. And we have data supporting it as well. The second aspect of the cyclical recovery is around real estate, which you all understand. And clearly, if you look at this top 7 cities data, we have clearly an upcycle in place. If you look at the 7 cities across India, most cities are in the third or fourth year of the upcycle. And we had a fairly long downturn between 2013 and 20. But in the last 3 years, we have seen, as you can see in this chart, the inventories have come down a lot from 40 months in CY 17-18. We are down to 20 months. And once you reach below 24 months, that's usually a good sign for the cycle to sustain. So I think we are in the third or fourth year of this upcycle, and a lot more years to go. And the rate cuts ahead, the wealth effect, good sound regulations in the form of RERA being implemented should only strengthen and maintain this move. So besides the private sector capex, the real estate cycle, I think all this is happening in the background of a very sound banking system. The regulator has done a fantastic job as well. And we have seen most of the banks are in a good shape. They're well capitalized. The asset quality cycle, the downturn is almost over from the corporate side. And the corporates themselves are sitting at very low leverage, and with capacity utilization running high and the need for private sector capex, I think these leverage ratios should go up in the following years, which should show up in better credit growth for the system as well. There are some signs of problem on the retail asset quality, mainly on the microfinance and the credit cards and unsecured personal loans in some pockets. But nothing to worry at the system level. It's more a micro issue at a company level, at a bank level. And I think the foundation is very much fine. Going on to consumption, some short-term challenges are there, which will show up in the results season as well. But again, I think next year should be a much better year for both rural and urban consumption to pick up. So what does all of this have impacted in terms of impact on the markets? I think the impact is clearly threefold. It's big, it's deep, it's wide. And why I say this is, if you look at the market cap, we become the third largest market in the world in terms of capitalization. We crossed $5 trillion. In terms of depth, the number of companies available to invest in, which are more than $1 billion in size, more than 550, with very vibrant capital markets and more to follow. And the returns in India have been very widely dispersed across sectors. Unlike most other emerging markets, the returns in India are not skewed towards a few sectors, but the experience has been widespread across sectors and across the market cap curve. So that's the beauty of the Indian markets, deep, wide, and big. Then coming on to the future, if you look at forecasting, I think history gives a good perspective. As you know, markets in the long run tend to follow earnings, and which has a strong correlation with GDP growth. And this evidence is clearly visible in India over the last 5-10 years, because the sales growth of the top 100 companies has a strong correlation to the nominal GDP growth, and earnings growth typically is slightly higher based on margin expansion versus the sales growth. So as long as one can predict the nominal GDP growth ahead, which can be close to 11% over the next 5 years, and if earnings can grow a bit faster than that, then broadly, what has happened in the past, something similar can happen in the future as well. Then coming on to the dispersion of returns, like I said, the Indian experience has been very uniform across sectors. The lowest sector itself has given 9% compounding over the last 10 years, which is still higher than the fixed deposit returns. Then coming on to the current macro, as always in the market, there are always tailwinds and headwinds in the macro. And at any point in time, if you stop at the last 10 years, something or the other was always bothering the market. So just to give some perspective on what's bothering the market now, I think there are both headwinds and tailwinds. Tailwinds, I would classify as good news on the US front. Clearly, the recent Fed meetings, and this is a snapshot of what the Fed projections are going forward, suggests that the chances of a soft landing are clearly very high, and which means that basically the growth in US goes towards 2%. Unemployment rate remains around 4.2%, and the inflation, which was as high as 9% till about 2-3 years back, has already tapered to 3% and is going towards 2%. So as long as this soft landing background comes through, I think there's no reason to have major volatility worry coming from the markets over there. And this is the base case over there. The rate cuts have already begun. And once we have clarity post the elections next month over there, and some perspective on the policies over there, I think the Fed will continue and resume its rate cut cycle from December onwards. So rate cuts, as you know, are beneficial for emerging market flows and therefore should benefit India as well. So US front, I'm not worried. I think the worry, if at all, is more on the oil front. What if oil goes to 90 plus? Yes, then there are some concerns, because then for every $10 odd change in oil prices, our inflation goes up by 30-40 bips. So that's something to keep in mind. But so far, so good. In spite of all the bad news flow coming out of the Middle East, we have seen oil behaving fairly reasonably in the 70-80 range. And I think as long as it remains below 85, again, that is not a worry. Um, the China factor, I think, in terms of the market behavior, I'm in the camp which believes it's more of a trade, which is probably, a better part of the trade has already happened. Whether the investment case becomes really strong going forward is going to be a function of how serious and how big are the announcements ahead. But so far, the announcements have disappointed, and we have seen that one third of the rally which happened in the last 2 months is already pulled back. And I think most of the selling link, because of that factor locally, is also coming to an end. So that's the view on the macro globally. Then coming on to large caps, why I think large caps are looking attractive in the current environment. I think a couple of reasons. Firstly, uh, I would like to make the point that in our markets, basically, we have to be wary that there are cycles, and you have cycle in terms of the investor behavior, in terms of greed and fear. You have a cycle in terms of the bull and the bear market. You have cycles in valuations and interest rates, which are on the way down. Similarly, you have cycles in the movement in terms of how large caps and mid and small caps move. And typically, it's seen that large caps move in a fairly steady manner over the course of years. Like in the last 10 years, there's been only one year of negative returns, that to only -1%. But when you look at mid and small caps, they have these hot phases and dull phases. And if you look at the last two big corrections, we saw a sharp price correction between 2018-19, as you can see over here. And then you saw a phase of time correction in 2022. Right now, we're in the midst of a very hot phase. And valuations clearly are suggesting that they are much ahead of their earlier peaks, especially in the broader market. Whereas in the large caps, if you look at valuations versus 10-year averages, they are still reasonable in the context of the macro growth outlook I talked about. And some amount of premium exists versus the emerging markets, but I think that is justified given the attractiveness of India in the overall emerging market space. So I think keeping the valuations in perspective, and although the quality of mid and small caps have gone up a lot, but I think there are pockets of froth in some names in the broader market, which makes me a bit nervous. Whereas the large cap valuations are still reasonable, and given that cycles come and go, uh, I think there's a high chance that some sort of reversion happens over here. If you look at the long term in India, broadly 3-year, 5-year, 10-year rolling returns, we have seen that the large cap returns have been around 13%, and there is convergence with the small cap returns, which are also around 13%. So some sort of convergence, I think, is due, and we've seen a very sharp hot phase, and valuations are telling you a story. So my advice and my recommendation, and this is a personal view, is that it's probably a good time to do some reallocation shifts. If you have a very highly concentrated broader market portfolio, maybe do some 10, 20, 30% allocation shifts towards the large cap oriented products, including large caps, funds. SIPs can continue as in the long run, 3 or 5-year returns should be healthy in the broader market as well. But short term, maybe it's a time to tone down the expectation of returns from there. So that's the advice. And one more thing which can help improve the performance in the large cap space is the return of the FIs. So I've been saying that post elections, if you look at the history in India, every time 6 months post the elections, last 2 decades, we have seen strong inflow pickup. And this time going to elections, the India positioning has also been light across major funds. So I was expecting in June that the inflows will pick up, and they did pick up. We've seen very strong inflows from June onwards. July, August, September were all good, except for the last 2 weeks selling linked to the China angle, which I think also is broadly coming to an end. But I'm pretty confident that over the next 2 years, as the Fed rate cycle picks up pace, every time the Fed rate have come down, you've seen inflows being healthy in the emerging markets. So there's no reason to believe why I think this time it should be different. And that should aid the inflows to India as well. So even the liquidity argument from the FPI perspective, I think is positive, or if I look at the next year as well. And as you can see, domestic mutual funds have put in $70 billion plus over the last 3 years in the local market, whereas the FI investment has been less than 10%, less than $700 billion. So I think clearly there's headroom over there. And most of the FI investments, when it comes in, comes usually in the large caps because they find the risk adjusted return attractive over there. And anyways, about 70% of their overall allocations in India in the large caps. So that's another factor to keep in mind, that the FIs may come in a bigger manner going forward. Then coming on to the top 100 fund, in terms of strategy, it follows a blend of GARP and value style, and very strong bottom-up focus, which is blended with top-down sector and macro trends. And a lot of attention is paid to the company's positioning and the trends in where they stand in the business sector and valuation cycles. A lot of attention is paid to valuations, very valuation conscious throughout the investment journey. And the aim is to build an optimally diversified portfolio of about 45-50 stocks and with a medium to long term perspective. There are some risk management boundaries also which have been put in place. Firstly, in terms of diversification, about 45-50 stocks. In terms of benchmark overlap, this product used to have about at least a 50% overlap with the benchmark over the last decade, and that continues. In terms of sector deviations versus benchmark, I'm measured and conscious about not taking too much deviation, so they are measured. And also, a few contrarian high conviction bets are always taken in order to generate alpha as well. So that's the broad risk management approach. And in terms of current positioning, this is what the positioning is. Broadly, in terms of sectors, the areas of overweight are in healthcare, telecom, financials, and utilities. And the areas of underweight are mainly in the energy space, consumer, about discretionary, and IT, and materials. So that's the current positioning. And overall, in terms of number of stocks, 46. Mid cap exposure is very less, 3%. As you know, it's a large cap product, so at least 80% has to be in the large caps, and this product will never have small caps at any point in time. But it can have, potential large caps of the future. But currently, given the concern on the mid cap valuations, the exposure is very less over here. Benchmark overlap in the early 60s, and portfolio turnover has been in the range of 15 to 20% over the last 2 3 years. So that's the broad positioning. So I've spoken about the local macro, the global macro, and uh, given my arguments why I think there's a strong case for large cap outperformance to pick up. Uh, Given you some flavor on the top 100 positioning, our flagship large cap product. I think I'll pause over here.
Thanks, Rahul, for your comprehensive thoughts on the market and economy. What we understood, what we learned from this call was that India macro story remains intact. इंडिया की macro story ठीक ठाक है. आरबीआई के जो रिपोर्ट्स लेटेस्ट क्रेडिट पॉलिसी में आए थे, इंडिया likely to grow at 7%, which makes India one of the fastest growing economy in the world again, and among the large economies. So that outlook of India remains positive, stable, and within which, as I said, that if India continues to grow at a nominal GDP of 12%, so nearly 7% GDP growth real, as well as 4-5% of inflation, so that is roughly around 12%, that India's story of compounding equity at 12% can be expected going forward, within which large cap remains a very solid portfolio for you because they represent the Indian economy in terms of its size, stature, and ability to face challenges. And when we, at this current juncture, are looking at some kind of challenges geopolitically and with some kind of impact of oil happening over India, this kind of exposure to companies actually help you navigate the risk associated with the market in a very, sort of, I would say, in a very thoughtful manner. So, whatever be your outlook for equity, what is required at this current juncture is exposure to Indian equities, and within which large caps. So whether you do lump sum, staggered, or SIP, STP, whatever way you think is appropriate, you continue to take exposure to Indian equity market, especially through large cap, which will be a solid portfolio or core portfolio to your holding. And of course, you can blend it with small and mid cap at an opportune time. So this is how the asset allocation and strategy should be for most of the investors. And once again, I thank you all of you for being part of this call. And once again, thank you to Rahul and Ketan for helping us resolve this India story to our satisfaction. So, guys, thank you, and see you again next month. Thank you very much.
Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.